Welcome, folks, to another edition of BayView Views. Today we're going to talk about market volatility because we are experiencing it again for the first time in probably over a year. And I think we found out that most people like upside volatility. They just don't really like the downside part of it. Friends, we're going to talk about what's the difference between a good investor and a not so good investor. And first of all, we know what it's not, right? We know that stock picking with a crystal ball does not win. We might have periods where we're kind of lucky and we outperform, but we know in the long run that we're not going to beat the markets, right? And so even the pros do not generally beat their benchmarks in the long term. We know that it's not market timing. You know, we don't have the capability of jumping in when it's high, jumping out when it's low, and actually adding value to our portfolio. As a matter of fact, it's kind of like catching a knife. It looks very impressive when we do it right, but when we don't, it doesn't look very good. When we study the average rates of return of the individual investor versus the S&P 500, the numbers are not very encouraging. They're not very good. So what is the difference? I believe that so much of it has to do with coming down with our perception of volatility and how we understand it, how we understand the markets. So we even have some biases that are built into us that work against us. One is called cognitive dissonance. We feel losses, the pain of losses, twice as much as we feel the pleasure of the gains that we make, right? The other one is called a recency bias, where we tend to feel like whatever we're experiencing today is going to continue. And that's not the case as we know it, right? So the stock market, on average, returns about 8 to 10% a year historically. So first of all, we would have to admit that's a pretty good place to be, right? The second thing, and most people don't realize this, matter of fact, you might fact check this as I say that, and I would encourage you to do that. Since 1980, right, so that's 42 years, the market's intra-year decline, that means the lowest point of the year, is about 14%. Wow. I mean, that's staggering. So that means at any point in the year, whether the market finishes up or down, the market is down 14. Okay? The second thing we got to understand is that 10% corrections happen about every year, and then 5% corrections happen maybe 3 to 4 times a year. And we had not experienced one of those until this month, and all of 2021. So we've been, again, somewhat spoiled by this low volatility. So I guess what I'm trying to say is we need to learn to embrace volatility as normal. And if we do that, we're going to become a better investor. And we always tell our clients, you know, there's 2 words that always go together: risk and return. Where there is no risk, there is no return. You have to risk it for the biscuit to actually make some money. And so we need to encourage that. You know, probably one of the best investors of all time, and most people would acknowledge this, is a guy named Warren Buffett. And Warren Buffett, I love how he says that when others are fearful, we should be greedy. When others are greedy, we should be fearful. And so he has flipped the script, guys. He has changed his perception about markets, and you can do the same thing, right? So I hope this helps. Thanks for listening to BayView Views. If you have any questions, please reach out, and happy investing. All the best to you guys.